Stop right there. If you have a bank account in America, what I'm about to tell you in the next few minutes could save you from losing access to your money. A new banking rule just passed in 24 hours, and it's already affecting accounts starting this week. This isn't clickbait, this is real, and you need to know about it right now. What's up, everyone, and welcome back to the channel. If you're new here, make sure to hit that subscribe button and turn on notifications because we cover the financial news that actually impacts your wallet and your life. Today, we're diving into something that caught everyone completely off guard, a brand new banking regulation that was passed faster than most people could even read it, and it's already being implemented at banks across the entire country. By the end of this video, you'll know exactly what this rule is, which accounts are being affected, what you need to do right now to protect yourself, and the shocking reason why this was rushed through at lightning speed. So let's jump right into it. Here's what happened. Just this week, federal banking regulators pushed through a new rule that fundamentally changes how banks monitor and manage customer accounts. And when I say pushed through, I mean this thing went from proposal to approval in less than 24 hours. That's almost unheard of in the world of banking regulation, where most rules take months or even years to implement. Think about that for a second. The people making decisions about your money didn't even give the public a full day to review or comment on this massive change. The rule centers around something called enhanced transaction monitoring, and it's being sold to the public as a security measure designed to protect consumers from fraud and criminal activity. Now, on the surface, that sounds great, right? Who doesn't want more protection from fraud? We all hate scammers and criminals. But when you dig deeper into what this actually means for everyday banking customers like you and me, the picture becomes much more complicated and honestly, pretty concerning. Here's how it works. Under this new rule, banks are now required to flag and potentially freeze accounts that show certain patterns of activity. We're talking about things like multiple cash deposits in a short period of time, frequent transfers between your own accounts, international wire transfers, transactions that fall just below federal reporting thresholds, and even what they're calling unusual spending patterns compared to your historical behavior. That last one is particularly vague and gives banks a lot of power to decide what's normal for you. Now, let me be crystal clear about something important. Banks have always monitored for suspicious activity. That's not new. The Bank Secrecy Act and anti-money laundering laws have been around for decades. What is new here is the scope, the speed, and the consequences of this monitoring. Previously, if your account was flagged for something suspicious, the bank would typically investigate internally first, maybe reach out to you for verification, and only take serious action if they found genuine cause for concern. Under this new rule, the system is much more automated, much more aggressive, and much less forgiving of normal banking behavior. Let me give you some real-world examples of how this is already playing out, because this isn't theoretical anymore. Just yesterday, reports started flooding in from customers across multiple major banks, including Bank of America, Wells Fargo, Chase, and several others who suddenly found their accounts temporarily frozen without any warning whatsoever. One woman in Florida deposited her tax refund check for $3,000, which is perfectly legal and normal, then transferred $2,000 of it to her savings account the same day because she wanted to save most of it. By the next morning, both her checking and savings accounts were completely locked. She couldn't access her money, couldn't pay her bills, couldn't buy groceries, nothing. Another case involves a small business owner in Texas who received payments from 3 different clients in 1 week, all by wire transfer, because that's how his clients prefer to pay him. He's been running his business the exact same way for 5 years without any issues. Under this new rule, his business account was flagged for receiving multiple wire transfers in a short time frame, and the bank froze his account pending investigation. This is a guy who's trying to run a legitimate business, and now he can't access his working capital or pay his employees. Here's another one that really shows how broad this net is being cast. A college student in California received her student loan disbursement, which went into her checking account. She then paid her rent, bought textbooks, got groceries, and sent some money to her parents to help with a family emergency, all within a few days. Her account was flagged for unusual activity because the algorithm determined that this was different from her typical spending pattern. Never mind that she's a student and her spending naturally fluctuates based on the academic calendar, the system doesn't care about context. So, what exactly triggers these flags? Based on the information that's been released and reports from banking insiders, here are the main red flags that this new system is looking for. First, cash deposits over $1,000, especially if you make more than one in a 30-day period. Second, any transaction that falls between $9,000 and $10,000, because $10,000 is the threshold where banks are required to file a currency transaction report with the government. Third, frequent account to account transfers, even between your own accounts at the same bank. Fourth, international transactions of any kind, including wire transfers, online purchases from foreign websites, or even ATM withdrawals when you're traveling abroad. Fifth, person to person payment apps like Venmo, Zelle, or Cash App, especially if you're receiving money from multiple people or sending money frequently. And sixth, any sudden change in your spending or deposit patterns, which is so vague, it could mean almost anything. Now, you might be thinking, okay, but I don't do any of those things, so I'm fine. But here's the problem. Most people do at least some of these things regularly as part of their normal financial life. If you're a freelancer or contractor who gets paid by multiple clients, you're at risk. If you sell items online and receive payments through apps, you're at risk. If you help family members financially, you're at risk. If you travel internationally for work or vacation, you're at risk. If you save money by transferring it from checking to savings regularly, believe it or not, you could potentially be at risk. The bigger issue here is that this system relies heavily on automated algorithms and artificial intelligence to detect these patterns. And we all know that AI isn't perfect. It can't understand context, it can't recognize legitimate financial behavior that happens to look unusual on paper, and it certainly can't tell the difference between a hardworking small business owner and a criminal trying to launder money. The system is designed to err on the side of caution, which in banking terms means freezing first and asking questions later. So, what happens if your account gets flagged? This is where things get really frustrating for customers. When your account is frozen under this new rule, you typically won't receive advance notice. The freeze happens immediately to prevent any potential criminal activity from continuing. You'll usually find out when your debit card is declined, a check bounces, or an automatic payment fails. When you call your bank, they often can't tell you specific details about why your account was frozen due to federal regulations around tipping off potential criminals. You'll be told that your account is under review and that you need to provide documentation to verify your transactions. The documentation they ask for can be extensive: bank statements, proof of income, receipts for large purchases, explanations for transfers, identification documents, proof of address, and sometimes even tax returns. Gathering all of this takes time, and meanwhile, your money is locked up. The review process can take anywhere from a few days to several weeks, depending on the complexity of your case and how backed up the bank's fraud department is. And here's the kicker: during this entire time, you have no access to your funds. Your rent or mortgage payment might bounce, your utilities might get shut off, you can't buy groceries, and you certainly can't deal with any emergencies. Even after you provide all the requested documentation and prove that your transactions were completely legitimate, there's no guarantee your account will be immediately unfrozen. Some banks are adding an additional waiting period as an extra security measure, and in some cases, even after clearing you of any wrongdoing, banks are choosing to close accounts anyway because they determine that your banking activity represents too much compliance risk for them to manage. This means you're left scrambling to find a new bank, which isn't always easy because once you've had an account closed for compliance reasons, other banks can see that in your banking history and might be hesitant to take you on as a customer. Now, let's talk about why this rule was rushed through so quickly, because that's the part that really raises eyebrows. According to official statements from banking regulators, the urgency was driven by a recent spike in sophisticated fraud schemes and money laundering operations that are exploiting gaps in the current system. They claim that criminal organizations have become so advanced that the old monitoring systems weren't catching them quickly enough, and that immediate action was necessary to protect the financial system and consumers. But critics of this rule, and there are many, including consumer advocacy groups, civil liberties organizations, and even some members of Congress, argue that this is a massive overreach that sacrifices individual rights and convenience for a security theater that may not even be effective. They point out that the vast majority of people being caught up in this new dragnet are ordinary citizens going about their normal financial lives, not criminals. The real sophisticated money launderers have accountants and lawyers who know exactly how to structure transactions to avoid detection. This rule, they argue, is catching minnows while the sharks swim free. There's also concern about the lack of transparency and due process in how this rule was implemented. 24 hours is not enough time for proper public comment, expert analysis, or legislative oversight. It's not enough time for banks to properly train their staff on the new procedures. And it's certainly not enough time for the public to understand how their rights and access to their own money might be affected. Some legal experts are already suggesting that this rushed implementation could be challenged in court on procedural grounds. So, what can you do to protect yourself? First and foremost, document everything. Keep detailed records of all your banking transactions, especially larger ones or unusual ones. Save receipts, invoices, contracts, and any other paperwork that explains where your money is coming from and where it's going. If you're a freelancer or small business owner, maintain clear separation between personal and business finances. This makes it much easier to explain your transaction patterns if questioned. Second, try to maintain consistent banking patterns. Sudden changes in behavior are what trigger these algorithms. If you need to make several large transactions, consider spreading them out over time if possible, or at least be prepared with documentation explaining why you're doing what you're doing. If you're planning a major financial event like selling a car, receiving an inheritance, or making a down payment on a house, consider notifying your bank ahead of time. While this doesn't guarantee you won't be flagged, it does create a paper trail showing your intentions were legitimate. Third, diversify where you keep your money. Don't put all your eggs in one basket. Having accounts at multiple banks means that if one account gets frozen, you're not completely locked out of all your funds. Keep some emergency cash at home in a safe place, enough to cover at least a week or two of essential expenses. I know we live in a digital world, but having physical cash as a backup is more important now than ever. Fourth, be very careful with peer-to-peer payment apps. The IRS has already been cracking down on these, requiring reporting for accounts that receive more than $600 in a year. Under this new banking rule, frequent use of these apps can also trigger flags. If you're using Venmo or Cash App for business purposes, make sure you're using a business account and keeping proper records. And be cautious about letting friends pay you back for dinners or splitting bills through these apps too frequently. Fifth, if your account does get frozen, don't panic, but do act quickly. Contact your bank immediately and ask specifically what documentation they need to resolve the issue. Provide everything they ask for as quickly as possible. Be polite but persistent. Document all your communications with the bank, including dates, times, names of representatives you spoke with, and what was discussed. If the freeze extends beyond a week and you've provided all requested documentation, consider filing a complaint with the Consumer Financial Protection Bureau. Finally, stay informed about your rights. You have the right to access your own money. You have the right to an explanation if your account is frozen. And you have the right to escalate issues if you're not getting satisfactory responses. Don't be afraid to ask for a supervisor, request written explanations, or seek legal advice if necessary. Looking ahead, it's unclear how long this rule will remain in its current form. There's already talk of legal challenges, congressional hearings, and potential modifications to address some of the more problematic aspects. Consumer advocacy groups are mobilizing to push back against what they see as government overreach into private financial matters. But for right now, this is the reality we're dealing with, and being prepared is your best defense. The bottom line is this: your relationship with your bank is changing whether you like it or not. The days of having unrestricted, unquestioned access to your own money are becoming more complicated. This new rule represents a significant shift in how banks and regulators view everyday financial transactions, and ordinary people are caught in the middle. By understanding what triggers these new monitoring systems and taking steps to protect yourself, you can minimize your risk of becoming one of the thousands of people who wake up to find their accounts frozen without warning. All right, everyone, that's everything you need to know about this new banking rule that's already affecting accounts across the country. I know this is heavy stuff, And it's frustrating to feel like you have to jump through hoops just to access your own hard earned money. But knowledge is power, and now you're armed with the information you need to navigate this new landscape. If you found this video helpful, please give it a thumbs up and share it with your friends and family because they need to know about this too. Drop a comment below and let me know if you've been affected by this new rule or if you have questions I didn't cover. And if you haven't already, hit that subscribe button and turn on notifications so you never miss important financial news that impacts your life. Thank you so much for watching. Stay safe out there, protect your money, and I'll see you in the next video. Take care.